If you didn't know, he is my son.
I did not inherit his sense of humor, unfortunately, so I have no good jokes for you today. But as Tom mentioned in that Safe and Secure Retirement Roadmap, we believe in a holistic, comprehensive approach. We want you to live today with confidence and plan for tomorrow with purpose. And hopefully we can help you today on that tax, which is the dead center in the middle of everything we do when it comes to planning. So one thing is on your sheets, but next to that is also a purple sheet. That thing we would like to collect. You can hand it to one of our team members. All of our team members have a badge at the end of this presentation. If there's some questions you have after this presentation, you can reach out to your advisor. But if you fill out that sheet, this is a great way that we get to help other people just like you learn about this valuable information. Well, I don't want to take any much more of your time. We're here to talk about taxes. So there's 780 pages of the new tax law, I believe, and Keith is only going to cover 700 tonight. So Keith, the floor is yours.
Thanks, Jordan. I don't have Tom's jokes or Jordan's jokes, apparently. Thank you all for being here. When Jordan asked me, I think July 4th, the new tax law was passed. Jordan probably asked me on July 7th, are you ready for this? Can you do this client event? And I said, yeah, I could probably do it next week. He goes, oh, let's not do that. Let's do that in September. And I thought, well, September is so nice. It's the fall. It'll probably be a beautiful sunset. Who is going to want to come and hear about taxes on a beautiful evening in September? Well, look around. Apparently, people want that kind of thing. So, thank you for coming. I hope it's worth your evening. We can go ahead and advance the slide to the next slide. I'll tell you a little bit about who I am. My name is Keith Baum. That's already been said. Tom mentioned some team members have been here 25 years. I was not here when I was 15 years old, but I have been here for the last 13 years, working doing tax returns for clients of Wealth. And you guys know that because several of you are my clients here at Wealth. So for those who I prepare tax returns for, thank you for continuing to entrust that responsibility to me. And for those that I don't prepare tax returns for, maybe you would like to join, and that would be fine too. We got room. I prepare 750 plus, actually over 750 tax returns this year, not just for individuals, but for corporate clients, for estates, trusts, partnerships, mainly because I'm a glutton for punishment, okay? I've figured out a long time ago that I love this stuff, and because I love it, I can't get enough of it. That's really what it boils down to. I took that passion into teaching as well, so in the fall, there would be a month after extensions are done. Extended tax returns are due October 15th. So if you're on extension and I haven't finished it yet, I apologize for that. I was busy putting together a tax presentation for you. But normally that would be kind of a downtime between October 15th and the end of the year. I end up spending 4 of those 6 weeks on the road with the University of Illinois, not teaching students, but teaching fellow practitioners. So people like me that have a license, you need a certain amount of continuing education. There are 4,000 people like that come to us for continuing education. So that is my usual audience, okay? So if I say something that you don't understand, I apologize. I'm used to talking to other accountants, but we'll make good use of the Q&A time at the end. What is an enrolled agent? That's the other question. You notice on that slide, it doesn't say Keith Baum, CPA. Why not? Well, a CPA is a state licensed professional who has unlimited rights to practice before the IRS. An enrolled agent, or an EA, is a federally licensed tax practitioner who has unlimited rights to represent taxpayers before the IRS. So what that means for you is that when you have an EA, you know you've got a tax pro. When you have a CPA, you may or may not have a tax pro. As evidence of that, I have some CPAs that hire me to prepare their tax return, okay? And the reason being, because that's a 3-part exam, only one part of it is tax. A lot of them don't concentrate in tax. How is it that you have probably never heard of an EA though, when everybody's heard of a CPA? It's because there's only 63,000 EAs nationwide. Anyone want to take a guess on how many CPAs there are nationwide? Hold up both your hands and all your fingers. 10 times more than the EAs, okay? So 653 state licensed, 63,000 federally licensed. That's who we are. Enough about me. That's not what you guys came here for. Hopefully that slide just validated that in the course of a tax season, I see stuff, okay? And hopefully you can benefit from that experience. Here's our agenda for tonight. The first point, and a very important one, is I'm going to take probably 5 to 10 minutes and just talk about how a tax return actually works. If you know how a tax return works, I'm sorry, that's going to be too basic. But what I've found in practice is that when I start talking about new deductions, some clients think they're credits. Or when I talk about credits, they think they're deductions. Or if I talk about the fact that they're excluded from income, you don't know what that means either sometimes. So that'll be an important framework to then understand everything that the new tax law, which is called the One Big Beautiful Act. You can see why we're just going with the new tax law, right? Everything that it changed for 2025, so things that it's already doing right now, and then things that we can plan for that'll go into effect in 2026. And then, most importantly, we're going to tie it all together. Along the way, I'll tell you how you can use the law to your advantage, but then we'll have a nice review at the end that just summarizes some of the main provisions. And if you're already like, man, I really think I might have made a mistake in being here, I'll tell you some of those provisions, if you bundled them together, could put $15,000 in your pocket that would otherwise go to the government, okay? So stay tuned. This is super practical stuff. And then we'll finish with whatever time we have for Q&A. I'll hang out and talk to you individually too, because I think I already mentioned, I love this stuff. Okay, before we go to the next slide, sorry, I got one more thing to say. Giant disclaimer here. I will not say anything political tonight. So talking with some of you before the program, you said, I hear some of this stuff in the news, and depending on who you're looking at, they're either trashing it or they're saying how great it is. None of that. This is a new law, and I'm going to present it as such. So if I use the qualifiers, this is good or this is bad, it's just from the perspective of if this is your individual tax situation, this is good because it saves you money, or this is bad because it's going to potentially cost you some money, okay? All I ask is that during Q&A, or if we're talking afterwards, please do me the same courtesy on the political thing, okay? We can put this to our advantage without having to go down that road. All right. Last thing before we overview the tax return. In order to understand where we're at now with the new tax law, we have to know where the old one came from and what would have happened without a new one. So the old tax law was called the Tax Cuts and Jobs Act. It was passed at the end of 2017, and it had all of these wonderful tax cuts. That's why it was called the Tax Cuts and Jobs Act. Maybe you remember some of the changes and how much money it saved you in taxes. The problem is a lot of those individual provisions in that law were set to expire at the end of 2025. And back in 2018, we didn't care because 2025 seemed like it was forever away, right? But now we're like, wow, that's coming up fast, the end of 25. So what Congress did with the new tax law, the One Big Beautiful Act, is they made a lot of the provisions that were in the Tax Cuts and Jobs Act permanent. And I'll put air quotes on permanent, okay? Because for tax speak, permanent just means it doesn't currently have an expiration date, but Congress could change it at any time. As opposed to temporary, which means it has an expiration date, and if we're going to get it past the expiration date, Congress would need to take action to keep it alive, right? That's permanent and that's temporary. Nothing in tax law is set in stone. So what the One Big Beautiful, or the new tax law, what it did really is it didn't cut taxes, but it extended the tax cuts that were already in existence. And if we're looking at the slide here, the overview of a tax return, This spot that I highlighted, the tax liability, I highlighted it because it's the most important piece of a tax return. It's what you actually pay the government for the year. Now in practice, I've found most clients don't care about that one as much as the bottom line, which is, do I have to pay or am I getting money back, right? But really, if that tax liability was $40,000 and you had given them $50,000, congrats, you're getting a $10,000 refund, but you gave them $40,000 on the tax return. So what we're really saying is that that number, the tax liability number, had we not gotten new tax law, would have gone up for, I would say, everybody in the room. It would have either gone up or stayed the same, but for most of us it would have gone up. For some of us it would have gone way up, okay? So that's what the new tax law did for us, is it made sure that that number stayed low. It also gave us tons of new deductions. We see the section up here for deductions. There's a lot of different types. It said that some items of income that would have otherwise been taxable are not going to be taxable. We're going to cover some of that stuff tonight too. So here's how a tax return works from the top down. You give me a pile of paperwork come tax time, and I sort it in this order. First, I put all of your income on top, because that's where the tax return starts. Then I start looking at all the deductions, so things like real estate taxes, mortgage interest, charitable contributions. I put those in the pile because my goal is to whittle away as much of that income before we get to the next spot, which is where taxable income comes in. So after we've applied all the deductions, now we just say, what's the actual tax bill on that amount of taxable income? And in our country, this is done on a graduated scale, which means we pay 10% on the first chunk, 12% on the next chunk, 22% on the next chunk, 24% on the next chunk, 32% on the next chunk, then 35, and then 37, and then we're done. And if that sounds really confusing, let me throw in that there's also special tax rates if you have preferred items like capital gains, right? So this slide should really convince you that I'm never going to be looking for a job. There's plenty of job security when you understand this stuff, because it's not really that easy. But after we get to the tax liability, then we look at how much have you already paid in through withholding or through estimated payments. And then what tax credits do you qualify for, or can we help you qualify for? All of that works just like payments. It offsets your tax liability, and then finally we get down to what you care about most. Am I getting money back, or do I have to pay? Experience has taught me that you don't mind paying as long as you believe that everything else was done to your advantage, right? So hopefully that's the big takeaway. Tax liability is the important number. If you have any questions about that, how a tax return works, talk to me afterwards, okay? Because we're moving on. This is beginning the next section of our program, which is provisions from the new tax law that are already in effect in 2025. The first one, and probably the one that a lot of folks in this room are excited about, if you're 65 or over 65 or will be 65 by the end of the year, because you are going to get to take advantage potentially of something that has never existed before, a temporary deduction for seniors. It's like the McDonald's coffee of taxes, okay? Like, congratulations, you've made it this far. But there are some caveats. How big is the deduction? Well, potentially $6,000 per individual, which means that if there are two of you, if you're sitting here next to your lovely spouse, and you say, hey, hon, we're both 65, $12,000 then for the couple. Now that's a deduction. So it reduces your income by the $6,000 or the $12,000. And depending on what tax bracket you're in that graduated tax system, let's say you're in the 12% bracket, this deduction instantly puts $720 in your pocket. If you're in the 22% bracket, it puts $1,320 in your pocket. If you're married and it's both of you, double that. $2,640, right? Is the math good? $2,640, double that? Okay, so that's a wonderful thing, but in order to get it, you have to be able to control your income. Because if your modified adjusted gross income, which is just a fancy way of saying all of your taxable income minus deductions that are considered above the line, think about things like IRA contributions, HSA contributions, if you make them with after-tax dollars, those are above the line deductions that get us down to our modified adjusted gross income. If that number goes over 75,000 and you're single, you're going to start to phase out. You're not going to get the full 6,000. If it goes over 175,000, you're paying full price for the McDonald's coffee. Okay, I'm sorry, it's just the way that they wrote the law. If you're married and filing a joint return, that phase out starts a little higher. It starts at 150,000. So if you're sitting here and you're thinking, honey, we've never made more than 150,000. Congratulations, you're probably going to get the full 12,000 if you're both 65 and over. If you go over 250,000 of adjusted gross income, no temporary deduction for you. If you file a married filing separate return, right off the bat, no temporary deduction for seniors for you. This is probably the most exciting piece of the legislation for those that are coming up on retirement, right? Because it fits the demographic. And it's not like we have to keep income low forever because this provision is temporary. So it's here for 4 years, 2025, 2026, 2027, and 2028. So it's worth thinking about where is the income coming from? And that's what's nice about working in a holistic practice like wealth, is that your advisors will be keeping an eye on this kind of thing. They'll make sure that if possible, you stay under these thresholds. Things can be done like taking money from a Roth IRA instead of a traditional IRA. Gets you the cash flow that you need, but Roth income is not taxable income. It's not going to factor in to this calculation, right? So that could be an idea. Maybe raising cash from a brokerage account as long as you're not going to trigger big capital gains, because again, only the gain piece is taxable income. So it might be worth exploring that if you're close to the thresholds to try to stay under these thresholds this year. Before we move to the next provision, a couple of myths to dispel. We were talking about this gentleman earlier, right? I said, I'm going to do a real good job this time. I'm going to follow the development of the bill as it goes through Capitol Hill. And some of the things that were said was, no one's going to pay tax on your Social Security. Did you hear that at all in the last year? You probably heard that. That's not true, okay? The taxation of Social Security is exactly the same as it was. It's based on the provisional amount of income, in other words, the other income on the return, and how much of that is taxable falls into this. So the temporary deduction for seniors is your version of no tax on Social Security. Good news if you're 65 and haven't started drawing Social Security yet, right? Because now you get this deduction even though you don't have Social Security income. The other myth that's out there is that this is a credit. I would love it if it was a credit, because I would be able to say, Judy, whatever you paid last year, you're going to pay $12,000 or $6,000 less this year, which would still be awesome, right? But it's not a credit, which would offset your tax dollar for dollar. It's a deduction, which means it's only going to offset your tax by whatever your marginal tax rate is. That's why we see 1,320 if you're in the 22% bracket. That's the first provision. Let's go to the next provision. This was a big deal back in time, 2018. When did I say that law was passed? December of 17, went into effect January 1st of 2018, so we had about 14 days to plan. But one of the things that was big in the Tax Cuts and Jobs Act was this limitation for state and local taxes. If you're picturing your tax return, there's an itemized deductions schedule inside of there. We always print it for you. And one section of that is called state and local tax. What most of you have if you're working in that category is you have your state income taxes paid, and then you'll also have your real estate taxes if you pay real estate taxes. This was a big deal because I had a client just down the road in Long Grove when the law came out. He was an attorney. He paid $30,000 in real estate taxes and $20,000 in state income taxes. So he was accustomed to getting a $50,000 deduction on his taxes that was now limited to 10. So you know what he did in between December 17th and December 31st, and maybe some of you did this too. He ran to the courthouse and prepaid his real estate taxes. Do you remember? Did anyone in here do that back in 2017? A few hands, yeah. That made sense to do that because we realized that in 2018 you were going to be limited to 10 no matter how much your state and local tax was. That strategy is kind of back in play again. Not that you need to do it to get under a threshold, but here's how it works now. Temporary from 2025 through 2029, that SALT limitation is lifted to $40,000. That would have been good. My guy would have rather had a $40,000 deduction than a $10,000. I'm sure you would too. That's not like everybody gets this. You would actually have to pay that much in state and local tax. But if you do, if you're in our area and you have sky-high real estate taxes, this is a great provision for you. Now, this one is also subject to an income phase-out, but notice the number is a little more exclusive, I would say. Everybody's going to get up to $40,000 unless their modified adjusted gross income is over $500,000. Okay? Some of you say, I wish. Others say, oh, this doesn't apply to me then. I'm over that, right? That's okay. So 500 is the beginning of the phase out, 600 is the end of the phase out. So after 600,000, you're only going to get $10,000 of your state and local tax. Under 500, you could get up to 40, and between 500 and 600, you're going to get somewhere between 10 and 40. That's how that works. Married filing separate, 50% of those numbers. That's a very small percentage of people in the room, if anybody. So why do I say bunching? Because on that itemized deduction schedule, we're always looking, what's better for you? To take the standard deduction or to itemize? Well, the standard deduction for a married couple this year is $31,500. For single, it's half of that. So if you're close, let's say that when you figure out your real estate taxes, your state and local tax, your mortgage interest, and your charity, let's say you're at like 30,000. The standard's 31,500. If you have the liquidity to do it, why not prepay the real estate taxes? If you have a $15,000 tax bill, you could prepay them before the end of the year, and you would get, now if you were at 30, you would be up to 45,000. And then in 2026, you're not going to have any real estate taxes. You'll just take the standard deduction the government offers. That's a bunching strategy. And if you're doing it, you can do the same thing with your charitable contributions. You can bunch them together to where you get this big deduction one year, use the standard the next, and then go back to the big deduction. If this is you, if you're in this $40,000 SALT, staying under the 500,000 as opposed to being over 600, if you can control it, is worth $9,600 in your pocket. That's based on where your tax bracket would be. So that's another very, very valuable provision we want to make sure we plan around. All right, next slide, please. Mortgage interest deduction. Good news here, your mortgage interest, if you have it, is still deductible, okay? And nothing has changed from last year, 2024, to this year, 2025. Before the Tax Cuts and Jobs Act, you got your mortgage interest on a first and second mortgage up to $1 million of principal, and you would get to deduct that in full. After the Tax Cuts and Jobs Act, if you got a new mortgage, the million became $750,000. So if you've gotten a mortgage in the last 8 years, it's only the interest on the first $750,000 of principal. Again, that's not a lot of us, right? But it is good to know that law is still in effect. The big orange box helps us to appreciate the change. So for years, there was this extender legislation for private mortgage insurance or mortgage insurance premiums. So if you don't have enough principal down on the loan, they're going to charge you this PMI. And some years it was deductible because Congress said so, and other years it was not deductible because Congress said so, right? So it's good to know now, codified in the new law, PMI is now deductible. So if you have that, that'll be there. You're going to get a little bit more mortgage interest deduction because of it. All right, next provision. I've only been in this business for 20 years, but I've heard that back in the day, okay, and maybe some of you can vouch for me on this, personal interest used to be deductible on a tax return. So credit card interest, car loan interest, loan shark interest, it was all, we still get the loan shark, we just tuck it in as investment interest, right? But that was deductible. Now, I thought that was the craziest thing because in the last 20 years, the only type of interest that was deductible, mortgage interest and investment interest. Well, here we go. New tax law says qualified car loan interest will now get a tax deduction of up to $10,000. And I thought, what's it take to qualify, right? And the answer is it's got to be the first lien, originated after December 31st, can't be a used vehicle, final assembly in the US. Think about the spirit behind the law. What was Congress thinking here? Buy American, but it doesn't necessarily have to be. There's some pretty big Toyota plants and things like that in America, right, where final assembly would count in the US. So the idea is if you're looking at a car, open the driver door and look at the sticker on the thing. Maybe you've never looked at the sticker before, but it tells you the final assembly point. If it's a new car and it was assembled in the US and you're gonna take a loan on it, and it's obviously after December 31st, it could qualify. You also have to qualify though. So there's income phase outs on this one, a little bit lower, kind of splitting the difference from what we've talked about. $100,000 for individuals, $200,000 for married filing joint. If you go over those numbers, then you're not gonna get any of your car loan interest deductible. I like to see how this stuff looks in the real world. So I Googled, what is the average car loan percentage? Anyone want to take a guess? Nowadays, new car, what is it? 2.5, I wish. Did somebody say 6 over here? 3.99. That's what I got on mine, that was nice. Average, we're talking average. 7, 6 to 7. That's the answer, 6 to 7. So if you went and got 6.5% on a $153,000 car loan, your wealth advisor would probably tell you here that you shouldn't have done that, right, Andrea? Like, there's probably better ways to go about this. But if you had that, that would give you $10,000 of interest, and it would be good for your tax return because you would get to max out the new car loan interest deduction. Note that this one's also temporary, only 2025 through 2028, so don't get a 7-year note on a car ever, but definitely don't do it to try to maximize your tax refund. All right, next slide, please. So far we've been talking about deductions. This is actually a deduction too, but in my mind it's more of an income exclusion item. Perhaps you heard somebody say sometime that there would be no tax on tips, and that there would be no tax on overtime. And guess what? It made it into the new tax law. Actually, the heading of those 2 sections of the law, if you looked at the 780 pages Jordan talked about, no tax on tips, no tax on overtime. Unfortunately, there's not just a period after that, though. So there's some qualifications, some hoops to jump through. Both of these provisions are temporary, 2025 through 2028. So if any of you are in service businesses, maybe you're just doing it for fun as a retirement job, the no tax on tips thing is awesome. But the law says they have to be qualified tips. And then it gives us like a hint at what qualified tips are without actually telling us what qualified tips are. I'll give you for example. It says that the tip has to be voluntary, not mandatory. So in my world, this has been pretty interesting because let's say that like the two of us, we go to dinner tonight. There's going to be a gratuity line on that bill, right, that says, how much do you want to leave as a tip? And whatever we leave is going to be voluntary. However, let's say that the 10 of us go to dinner tonight. That bill's going to look a little different, isn't it? It's going to say there's a mandatory 18% or whatever gratuity thing. So the question gets to be, how are we going to keep track of this stuff? And the government's answer is, we'll tell you in 2026, okay? So for 2025, we're going to be relying on pay stubs. If you're self-employed in a tipped profession, I'm going to rely on your honesty. So if you're like a self-employed massage therapist, I got a lady, she's awesome. Her name's Kasha. She's fantastic. She charges like $120, but I give her like $150 because she's that good. So in her book, she needs to make sure she's showing that 30 was a tip and not just regular revenue. The other piece of this is it has to be in a business that's customarily tipped. That's what the law said. And then it said that the Treasury is going to give us a list. Well, they came out with the list. And unfortunately, tax accountants weren't on the list, okay? So thank you when you bring me a bottle of bourbon and stuff. I really appreciate it. Unfortunately, I don't get to exclude it from income. That's up to $25,000 in tip income. And it is just like it's described, no tax on tips. There's income phase outs here too. They're pretty high. When I first saw the law and I thought, wow, I don't know how many servers make $150,000. But then I realized that there's probably a fair amount of hairdressers and massage therapists who are married to high income earners. And I think that's the point of the phase out, right? 300,000 begins the phase out on married, 150,000 for individuals. If all this income phase out stuff has your head spinning and you're going, why did they do this? The answer is math. Okay, it's literally just math. The federal government kind of works like your personal budget. I'm sure you've got one, right? Where you know what the inflows are and then you know how much you spend on stuff. And you always hope you spend less than what you make. The federal government's like that, except they never spend less than what they make, but there's rules that govern how big that negative number at the bottom can be. And it's those rules then that say if we want to create this deduction, we have to make sure it doesn't cost more than X. And that's why these income phase outs are there. Anyway, I digress. How about the no tax on overtime? Is anyone in here working still and working overtime? Like you have a job that pays you overtime? I see a few hands, that's good. So this sounds awesome because you're thinking, wow, if I'm single, it's $12,500. If I'm married, could be up to $25,000, no tax on overtime. And then you find out that it doesn't actually mean no tax on overtime. What it means is if somebody's working and they're getting paid time and a half for the overtime, it's only the half, not the time and a half. That's a kind of a misnomer, isn't it? Because you're thinking if I'm above 40, it's overtime, right? But no tax on overtime, just the part that exceeds the regular pay. The other caveat here is you have to have worked the overtime because it's required by law or collective bargaining. So like think about the union employees. Collective bargaining says once you go over 8 hours a day or whatever it is, right, you're getting paid the time and a half. Other workers too, it says you're gonna get time and a half. I can tell you, when I'm sitting in that chair right there from 5 in the morning until 11 o'clock at night during tax season, that's because I wanna sit in the chair. The government doesn't say Jordan's gotta pay me overtime, right? So I don't qualify for that because it's not legally required. Same income phase outs. All right, next slide, please. We're still in 2025. This one's probably the most urgent. This is the get them while they're gone, but get them before they're gone slide, okay? If you've been on the fence about buying an electric vehicle, you've seen Jordan's Tesla, you think, I like that. I might buy one of those. But you haven't done it yet because you're a procrastinator, but you thought, you know, that $7,500 credit is gonna be there through 2030 because that's what the law said. Well, now Congress says it's gonna be here through September 30th. How many days? We have 13 days, right? So like maybe leave here tonight, go buy your electric vehicle. All right, after September 30th, you could buy a car that would have otherwise qualified and you are gonna get 0 credit. The credit doesn't exist after September 30th. The other one that I've kind of championed is I've done tax planning with you in my videos. I've said, hey, keep track of the insulation, the doors, the new windows, the solar, the high efficiency HVAC system, because that was a 30% of what you spend credit up to a certain amount of money. So it's like if you spent, you know, $2,000 on windows, you got 30% of that back as a tax credit. Again, you thought you had it for a long time, it's gone at the end of the year. So I can't imagine what these solar guys are doing right now, because it's not like you have to buy it by December 31st. It has to be on the roof, hooked up, producing solar by December 31st. Same thing with insulation, doors, windows, etc. All right, these are our honorable mentions. So thinking about our audience here in retirement, coming up on retirement, I just wanted to mention these because they're in the law and maybe you could share them with your kids. So the child tax credit is bigger. Child tax credit is what you get for children under age 17. It's been $2,000 for the last 8 years, except the COVID years when it was like 12 grand. It got really big during COVID. But it was scheduled to go back down to 1,000. Now it's 2,200, so it actually got bigger. It didn't just stay the same. So that's nice for parents with children, and it'll get bigger every year. That's what indexed for inflation means. ABLE accounts, it's a special type of 529 plan for those who have disabilities. Modifications there allow bigger contributions starting in 2025, and there's some other things that change just with the legalese to help protect the government benefits that you get for being disabled. So those are also good changes. And the last honorable mention for 2025, the enhanced adoption credit. So there was always a credit for adoption. I believe the amount stayed the same. What changed is the refundable piece got bigger, which means even if you don't have enough tax liability to use it, you can have that money refunded to you. Let's face it, at a time that you need it, right? Because you've just gotten a new child, it's expensive. So there's our honorable mentions for 2025. Let's go ahead and talk about provisions now that go into effect in 2026. So when I prepare your tax return in a couple of months, that's your 2025 return. Everything we've talked about so far, fair game. This stuff, let's plan for it now, because we're not going to see it until a year from now on tax returns. First thing, and this is a big deal, notice the quotes, permanent reduced tax rates. So again, those tax rates from the Tax Cuts and Jobs Act that I rattled off earlier, 10, 12, 22, 24, those were set to expire in 2026. So if Congress didn't do anything about it before then, 12 would have become 15. 22 would have become 24, 24 would have become 28, et cetera, the top rate, the 37, would have become 39.6. That right there would have cost you money. Money would have like come out of your pocket for taxes. However, the other thing the new law did is it made the brackets bigger. So that first chunk where you're 10%, bigger. Then the next chunk where it's 12%, bigger, and then 22%, bigger. So not only do we get to keep lower tax rates, but we stay in those brackets for longer. That's why I confidently say 2026 would have been a really bad year, okay? But now it's kind of not going to be that much different from what we've seen. Now, how dramatically bad would it have been? I've got here in 2017, for a married couple, once you had about $76,000 in income, you entered the 25% bracket, which meant each $100 that you had in income above that cost you $25 in federal tax. When do you pay $25 in federal tax now? Well, never, because that bracket doesn't exist. But we'll go with the 24 by way of comparison. The 24% now for a married couple, $206,700, and then you stay there until your income is $395, let's say. So you've got a lot longer runway of them only taking $24, a lot longer runway before they ever take the $24. That's what that helps us to appreciate. That's a good change for all of us. All right, next slide, please. Standard deduction. That's what we were talking about earlier. I said it's $31,500. Anyone want to venture a guess what it would have been if we didn't get new tax law? Less than 31. Throw out a number. I'll give you a hint. Cut it in half. It would have been about $16,000, we think, inflation adjusted. The standard deduction before the Tax Cuts and Jobs Act for a married couple was $12,700. Inflation adjusted, that would have been about $16,000. Instead, in 2026, it's likely to be like $32,000 inflation adjusted. So what that means is if you don't have a house, you don't have real estate taxes, you don't have mortgage interest, or you're like me where you got a 2.85% mortgage during the pandemic and you live in Round Lake, so your taxes are kind of low, right? If you have that situation where you never would have itemized anyway, all this does is save you tax dollars. Big time, big time. Because as a married couple, so like for Heather and I, the first $31,500 we make, tax-free, without us having to do a single thing about it. It's like the government's way of saying, we're not going to tax you on everything, just what goes above this number, and then let the games begin. But note what I've highlighted here for seniors, because if you're 65 or over 65, you get a bigger standard deduction anyway, an extra $1,600 per person if you're married, and if you qualify, which will help you qualify, you're gonna get that extra $12,000 of a senior deduction if you're married. So for you, your first $46,750 is tax-free. So if you're in these years where you're thinking, you know, our income is not really that high, so far we've been taking about keeping income off the tax return. I would say Jordan and team here would love if you added a little income, right? Because if you're only going to have about $15,000 of income and you're married, why not do a $30,000 Roth conversion and pay zero tax on it? You see where that comes in? So that is that's a really, really wonderful provision. All right, next slide, please. So far, everything we've talked about complies with the rules that I said earlier about how a tax return works. You're taxed on your income minus your deductions, etc. You're not taxed on your assets. The one glaring exception to that is the estate tax. The estate tax kicks in when you die. And if you're like, well, what do I care what happens when I die? Think about your loved ones, okay? Because right now, if you were to die today, you have an estate tax exemption that's $13.99 million. That much could go to your heirs tax-free federally. Illinois, not so much, right? Illinois, $4 million. Illinois is not tied into this at all. So Illinois is still $4 million, and it could still cost some bucks if you have more than that without a good estate plan. The 13.99 was going to be 7.15. That would catch a few more people, don't you think? I mean, there's 7 million septimillionaires, is that the right word? Versus $14 million folks. This is per person also. So, you know, basically it would have been cut in half, and it would have been cut in half for every family, and every lawyer worth their salt was kind of gaming this out, you know, what's gonna happen here in 2026? And the new law says, starting in 2026, it's not going to be 7.15, it's going to be 15 million per person, and it's indexed for inflation, which means it's only going to go up. Unless Congress changes it somewhere down the line. That's the rules now. So I'm not an attorney, so my takeaway would be work with your advisors here and your attorney to make sure you have an estate plan that's in line with the new law. Next slide, please. This was an interesting change. I think it honestly was an accident. The limitation on wagering losses. They were redrafting the law up to an hour and a half before it was passed in the Senate. So do you think there's a chance that there might have been some stuff in there that they didn't mean to leave in there? I think that's what happened here, but hey, we're here for the facts, and right now, them's the facts, okay? So what happens in wagering now in 2025 is that if you walked into a casino with $10,000 in your pocket, and let's say you won a $10,000 jackpot, you're like, sweet, now I've got $20,000 in my pocket, but then you lose it all before you leave by the end of the night. What did you win? You won the jackpot, that was 10. What did you lose? The original 10 that you walked in with. So you would have $10,000 of income on your tax return for gambling, and then you would have an itemized deduction for $10,000 of gambling loss. So on your federal return, as long as you itemize, those wash each other out as they should. Wouldn't you agree? However, starting in 2026, same fact pattern, you're going to have a $10,000 gambling income on your tax return, and you're only going to have a $9,000 gambling loss because your losses are limited to 90% of what they would have been otherwise. So you would walk out of there owing tax on $1,000 without having any money in your pocket, okay? Now 10,000's kind of a lot, but think about it for people who are like professional gamblers. This is 100,000 or 200,000, and they count on those losses to offset the gains. This phantom income problem applies to them too. So I don't think you need me to spell out for you what the practical application is. Don't gamble, okay? Unless you're prepared to guaranteed lose money on your tax return. All right, next slide, please. 2026, this is brand new. You've heard of traditional IRAs, you've heard of Roth IRAs, you've heard of 529 plans, you've probably heard of a Trump account, but you have no idea what it is, and that's because it is brand new, okay? This baby was born out of the new tax law. Here's how it works. It's for taxpayers under age 18. So you might be thinking, well, in that sense, it's kind of like a 529 plan. Contributions of up to $5,000 per year, the first year, and then indexed for inflation, so that number will get bigger as we go. And that's after tax dollars, much like a Roth IRA. So it's like, okay, so it's kind of like a 529, it's kind of like a Roth. After the contribution, the earnings grow tax-free, and if the withdrawals come out as qualified withdrawals, you'll never pay tax on any of those earnings. So think about a 529 plan when it's used for education, like it should be. That works out pretty slick, doesn't it? You guys give me the 1099-Q, you give me the 1098 that shows how much you paid the school, and as long as those numbers match up nice and all that money was used on education, no more questions. But what happens when you start saving money, like a lot of money, for a young scholar who ends up being really scholarly? They have scholarship, it covers all the cost of the tuition, and now you've got all this money in a 529 that you feel like is trapped there because when you take it out, you're gonna pay tax on the earnings, right? A Trump account works differently from a 529 because it's not limited to just education. So other qualified withdrawals would be first-time home buyer, could be education, Could be when that sub 18-year-old gets old and gray and retires. They could take it out then as a qualified withdrawal. They could adopt a child, they could give birth to a child, or they could use it for what's called a qualified emergency expense. Don't ask your advisor tonight, can I write the check? Because this thing is way too new, okay? So they even said in the law, even though this is born now, no contributions will be accepted within a year of the enactment of the law. So July 4th, 2026 is the first time a contribution could be made to a Trump account. And you know, like the name, love the name, again, not political, this is a pretty good idea for families to do financial planning when you want to start passing along some wealth to these young people, but want to make sure that they use it responsibly. I think we're going to enjoy using Trump accounts for years to come. Next slide, please. Expanded 529 plans starting in 2026. The annual contribution for a student K through 12 goes from $10,000 a year to $20,000 a year. So that's nice. And then the expenses that you can use this on, K through 12, if you remember, this used to just be higher education, had to be a college student. A couple years ago, it changed to where you could go to private school, K through 12, and you could use it for tuition and for related fees. Now the definition got even broader. So K through 12, if you've got a child that's taking an AP exam, those are expensive now. I mean, when I was taking them, they were like $300. They're probably $3,000 now. I don't know. No, I'm making that up. They're probably $400, $500, right? AP exam. So the testing fees are covered, supplemental classes, tutoring, educational therapies for those with disabilities. In other words, you could use 529 money on a lot more now. We're about to close this out, folks. This one's big. 2026, changes to charitable contributions. Yeah, you can advance, thank you. For those of us who don't itemize and are never gonna itemize, we don't have big mortgage interests, we don't have big real estate taxes, but we still give money to charity. You remember during COVID, we had 2 years where we got a little tax deduction for that, even without itemizing. Well, we're gonna get it again, okay? This is new for non-itemizers in 2026 that give money to qualified charities. There's going to be a tax deduction for that apart from the itemized deduction schedule. So that's a good one. The next one, not so good. If you're an itemizer and give money to charity, you're not gonna get your charitable contribution from dollar number one anymore. There's a floor now, similar to how medical expenses work. We always said you have to have 7.5% of your gross income spent on medical before it starts to count. That's now 0.5% to charity before it starts to count. Not a huge number, on like 100 grand, that's $500, but still it's kind of annoying. You used to be able to get it all. Starting in 2026, you're not gonna get it all. We can go ahead and skip the honorable mentions. I feel like for 2026, these aren't nearly as honorable or as important as they were for 2025. So let's go ahead and wrap up here. What are the strategies and what are the takeaways? I've done my best to tell you all of this ahead of time, but I'm gonna go ahead and just repeat myself because repetition's good, right? That's how we learn. So in order of urgency, here's the first thing. If you want to take advantage of those energy efficient home improvements, make sure that you make them before December 31st. If you do this, you could put up to $3,200 of tax credit in your pocket if you have the right components. A new HVAC, some insulation, some windows, a new front door, not counting the solar, which the solar is still very big, but only through December 31st. It's 30% of what you spend. And what you spend on a single family home is gonna be $30,000, $40,000, $50,000. So that is nothing to sneeze at. The next provision, if you're 65 and over and you wanna take advantage of this temporary deduction for seniors, which is, let's face it, free money, it's just gonna happen automatically, you have to keep your income below the thresholds. So that becomes a planning piece if you're there. Some of you are thinking, that's no problem, I'm going to be there, right? Others are thinking, I should probably talk to my advisor about where the money's coming from and whether it's going to be income, taxable income, and see if we can't shift some of this stuff around to, again, put $2,640 in your pocket. The other takeaway, if you have high SALT, that's that state and local taxes, high income taxes paid, high real estate taxes, same story. For the next few years, try to keep your income below $500,000. We also talked about bunching itemized deductions and why that might be a good idea. I would say if you're thinking about that and you're not sure if that would apply to you, before you go and give $10,000 or $15,000 to Cook County or Lake County 6 to 9 months before they're asking for it, just send me an email and ask if that's a provision you should take advantage of, okay? Happy to let you know. Keep an eye on the TRUP accounts. You guys don't have to do it as much. I think the advisors will keep you posted on what to do there if you want to do that for kids or grandkids. If you were worried about federal estate tax, don't be, okay? If you were worried about getting it cut in half, it's not gonna be cut in half. And there's a lot of talk about maybe making that go away altogether someday. Illinois is still gonna get you if you have over 4 million, and they're gonna get you hard. So that still does require some planning. The takeaway on the federal, make sure your estate plan is set up for the new tax law to take advantage of it. And lastly, rethink gambling. So if you were gonna go to Potawatomi, do it in 25, not 26, okay? Folks, the last strategy and takeaway, go ahead and advance the slide. Keep entrusting the good folks here at Wealth. We'll take good care of your taxes. We'll take good care of your finances. We'll work together to make sure that you get to take advantage of all this stuff with as little intervention on your part as possible, okay? Jordan, closing remarks.
I don't need a mic for this. Please thank me for his time. Hopefully that was beneficial. If you missed something, there will be a test. No, there will not be a test, but we do have this recorded, so if you would benefit from that, reach out to your advisor. If you have a specific question, please reach out to your advisor. They'll be able to facilitate those answers and collaborate with Keith. If you know someone that can benefit from this information, on those purple sheets, write down their name and email. We'll send that to them. We believe in providing value and helping many people as possible navigate these new tax laws and put more money, hard-earned money, back into your pocket. We thank Keith, but I want to now thank you. You guys, without you, we would not be here today. Thank you for your trust. Thank you for your business. I was talking to some of you, one gentleman mentioned to me before the event. He's like, I'm so glad I went to one of your educational events 4 years ago. We are going to do more of these. Give us your feedback. We would love to get your friends to those future events. Another client said, hey, they're going to Italy in a few months. They're doing their dream trips. That to me brings us the greatest joy. We're there for the good times. We're there for the bad times. We are just so thankful to partner with you in this long-term relationship. Last but not least, if I can have our entire team come to the front for Wealth Financial. I know Kevin, get over here. Joe, everyone's freezing. Shannon, Rebecca, Dee. Okay, come on, guys, don't be shy. This is not a one-man show. Yes, Keith gave a great presentation. Yes, we have a great team of advisors, but it takes an entire team to do what we do tonight, to do what we do day by day and throughout the entire year. So if I can just ask you to say thank you to your team to support you. So thank you guys for everything you do. We'll all be around to answer questions throughout the evening for a few minutes, but thank you again for your attendance, and then reach out to your advisors if it's specific, and Keith will also linger around because he loves this stuff. So thank you for your attendance tonight.